Let's start with a math problem today. You remember Jack and Jill, right? They climbed a hill together. Well, recently they retired. Each had about $500,000 in retirement savings. But after a year of retirement, Jill had $510,000 remaining. Regrettably, Jack only $430,000. Yet they both spent the same amount of money. It's a question for the ages that we'll break down shortly. But if you're near retirement, you could be making a significant mistake, even beginning tomorrow when the market's open. So in this video, we're going to talk about what you should do and not do as we head into 2025. I'll also give you 3 specific strategies based on your time horizon. You probably know by now that the S&P 500, which is a widely known market gauge, experienced tremendous growth over the past 2 years. In 2023, the total return equaled 26.29%. In 2024, almost 27%. This marks the best 2-year gain of the 21st century with a cumulative return of about 53%. Wow, does this make you happy? A little nervous? And what do you expect this year? And if you're paying attention to what Warren Buffett, known as the greatest investor of all time, is doing with his money, you may be confused. Hi, welcome to my channel. My firm helps people all over the country create financial safety, simplicity, and most of all, strength in their pre-retirement and retirement years. Although I've been doing this for a long time, as I don't know your unique situation, please see this information as education, opinion, and a small spoonful of entertainment. A small spoon like this one. I'd love to read your comments if you have them, so please feel free to leave them. So what's going on with Warren Buffett? Recently, his company Berkshire Hathaway increases cash reserves to a record $325 billion, primarily by relocating funds into nearly risk-free investments. That's their largest cash position in 30 years. So he's sitting on a lot of cash. No, video editor, that's me. We need more cash than that. Much better. Despite the fact that Buffett's company is nothing like your retirement portfolio and that $320 million in cash is like you and I having a $10,000 CD, when he speaks and when the markets are really high, my clients have questions. Should I sell? Do I take some profit? Does Warren know something that we don't? Probably. Let's talk about it. For sure, there are a lot of challenges for the 50 and over set in 2025. Medical costs are increasing. Prices are still pretty high. And the new administration may or may not change Social Security and Medicare. Translation, takeaway benefits. And the subject of today's video, market volatility, or at least the hints of it, with 2 great years in a row. You may feel tempted to try timing the market, but what does that really mean? It means you have to be right twice. Once when deciding when to get out of the market, and again when deciding to get back in. If you're watching this, you likely already know how tough it is to be right even once, let alone twice. And here's the hard truth. Well, investors are often bad at investing. And every year, Dalbar releases a study comparing how the average investor performs against the funds they invest in. And as this chart shows, the average investor significantly underperforms. Why? Because we're emotional and emotions lead to mistakes. This video is not for Josh or Danny or Ben. For them, sufficient cash reserves might be for a big home purchase or something along those lines. But otherwise, they should ignore the short-term market movements. If you're retiring within 1 to 5 years or already retired, the situation changes. While markets generally go up over time, they don't climb every year and forever. Older investors face something called sequence of returns risk. It's not just about how much your money grows, but the order in which those returns occur. So let's look at the example I opened this video with. The COVID market boom led to a sharp downturn and quick recovery, but what followed was another significant decline. So let's say you retired at the start of 2020. You were so excited about finally staying up until midnight on New Year's Eve for the first time in 32 years. Then on January 2nd, you're unexpectedly let go. Now imagine 2 retirees, Jack and Jill, starting in 2022, both with $500,000. Jill, her investments grow by 6% or $30,000 in 2022, and she withdraws 4% of her initial balance, 20 grand, and at the end of the year, she has about $510,000. Jack, his investments lose 10% or $50,000, and he also withdraws 4% of the initial balance, that same 20,000, but by year's end, he's left with about $430,000. And I'm using a negative 10% return in this example, but the overall market was actually down more than 18%. So both of them started with the same amount, but the sequence of returns made a huge difference. Jack's early losses significantly impacted his portfolio, making it much harder to recover. That $80,000 difference is significant. Obviously, for Jack, retirement has been changed forever. The lesson here is preparation matters, especially if you're close to or in retirement. This sequence of return risk that you hear about can generally affect your financial security. But careful planning, not timing the market, is the key to protecting your retirement. And I love this quote because I think it says it all. For one-time investments in which an investor commits a lump sum at a point in time, it is well known that the order of returns doesn't matter for the long-term outcome. Whether the worst year comes at the beginning or at the end of the period, the final wealth level remains the same. However, this is only true in this simplified scenario. In the real world, investors contribute to and withdraw from their investment accounts. The timing of these cash flows does matter and can affect returns greatly. So let's talk about how I handle this with my clients, especially for those who have benefited from the higher market but are now concerned about 2025. The first thing I always ask is this question: do you treat all your retirement savings the same? Then if so, it's time to rethink that approach because you're not going to need all of your money on day one of retirement. So if that's the case, why treat it like you will? My 5 cardinal rules of investing that guide this strategy are: markets recover given time. We never pay bills from a growth fund. A quick note on this one: if you have a diversified portfolio like a 50% stock, 50% bond, or something similar, you're still taking risk with money you need to pay your bills. Yes, bonds have less risk, but do have some risk. Number 3, bad decisions are much worse than bad markets. Number 4, never take more risk than is necessary to meet your goals and objectives. And number 5, reliability of income is far more important than return on investment. So with these principles in mind, it's time to embrace the bucket approach, a method to bring stability to your plan and help weather market ups and downs. I want you to think your retirement portfolio like the classic TV game show Bozo's Buckets. Right? Kids tossed balls into buckets at varying distances for different point values. Your savings can work the same way, divided by when you'll need the money. So the short-term bucket for immediate expenses, it's focused on stability and liquidity. For future retirees and retires, this is the most important bucket. Simply, you don't take risks with money you need to pay your bills. There's also a medium-term bucket for the 5-10 years that follow, balanced for moderate growth and lower risk. And then the long-term bucket for funds you won't need for years. This is invested more aggressively to maximize growth. These further out buckets embrace the other rules. Rule number 1, markets recover over time. And rule number 3, bad decisions are worse than bad markets. So let me share a personal story to explain what I mean. When my sons were younger, I set up 529 college savings plans. What I didn't anticipate was that all 3 would attend the University of Illinois, which had lower tuition than I had planned for. I thought that they would go to Harvard like their father. Just kidding. Because of this, I overfunded their 529 plans. These plans are great because contributions are tax deductible when they grow tax-free, and withdrawals aren't taxed if used for qualified educational expenses. It's a great thing. But now I have more in the plans that I need to cover my son's education, given that they're all done. So what are my options? Number 1, I can leave the money in the plan for my future grandchildren's education. Number 2, withdraw it now, paying a 10% penalty on the gains plus ordinary income taxes. Some of that money can go into a Roth account, but that's not going to help a ton. So I choose option 1. Since grandchildren are not on the horizon yet, this money will sit for years. That means it should be invested aggressively to grow over time. This shows why not all money should be treated the same. Your investment strategy depends on when you'll need the fund. And here's the key. If the markets go haywire and I panic sell those accounts, it'll be my bad decision, not a bad market, that ruins the future value of those funds. Now let's shift to what's most important for people 50 and older, especially those nearing or in retirement. It's all about what to do in that short-term bucket, the money you're going to need soon. Right now, risk-free interest rates like those on money market accounts or treasury bills are still over 4%. So here's my very strong advice. If you've made gains in the stock market, this is a perfect opportunity to lock in some of those profits. Converting some of your assets to a reliable, low-risk option can provide stability during volatile times. The pros: you can sleep at night, stop obsessively checking your account balances, and tune out the doom and gloom news on bad market days. The cons: if the market goes higher, you might miss out a little bit. you're earning 4 or 5%. Maybe the market goes up 11%. So here's something I do with my clients to take advantage for that short-term bucket. I can use a money market account. The 7-day yield on the Schwab money market account that I use is still 4.29. It's not terrible. Another idea is a MYGA, a multi-year guaranteed annuity. A viewer recently told me she purchased one, and I've done the same. Think of a MYGA as an insurance company's version of a certificate of deposit. You lock in funds for 3 to 7 years, but you can withdraw up to 10% annually if you need it. The benefit is guaranteed growth for the early years of retirement. These are still paying over 5%, and because that rate compounds, it works out really well. There are plenty of ways to approach this, but the theme is the same. Don't take risks with money you need to pay your bills. Money you'll need soon, especially money you're going to need for the first couple of years of retirement. Smart planning now can provide the security and peace of mind you need. So 3 strategies for the short-term bucket. There is never a bad day when you're earning 4 to 5% on your money. If you're retired or retiring soon, I just don't see why you wouldn't solidify those years. For medium term, a mix of stocks and bonds with less volatility, a bit more risk and low volatility because I still want to minimize wild fluctuations. For the long term, set a mix of low-cost stock ETFs and forget about them. If you need fee-based help either on an hourly or a retirement plan basis, please reach out. I'd be happy to talk with you about it. If you've enjoyed this video, you might like some of these others. Whatever is on your screen over here, and thanks for watching.